Hi guys, I'm VP. In this video, we are going to see the chapter 3 in the book The Intelligent Investor. The chapter 3 is the century of stock market history. But in this book, it's all about American stock market history from 1850 to 1950. But we are going to see the Indian stock market history and the point which is mentioned by the Benjamin Graham in his book, and we are going to interpret with our Indian stock market. Okay, let's get started. Now let us see the history of Indian stock market. Indian stock market also has a very long track record since 18th centuries. In late 18th centuries, India has two stock markets, one in from Bombay and another is from Calcutta. The traders used to trade the East India Company in those stock markets. And before independence, India got a steady and slow growth in the stock market. After independence in 1950s, India forms a regulatory board called the Securities Contract Regulations. Later then, it is named as the SEBI, that is the Securities and Exchange Board of India. Under the SEBI, BSE got recognized, and BSE also forms a Sensex index which tracks the top 30 stocks in the India, by which the BSE got very famous in India and which became the Sensex became the benchmark of the India till 1990s. In 1992, the first scam in the Indian stock market which is exposed, that is the Harshat Mehta scam. After that, the traders and investors wants to the stock market to be very transparent to track, and then it forms the NSE, that is the National Stock Exchange, which is formed in the 1992, and in 1995 it also adapted the many technologies at that days by the online trading platform, and it gives the open data for every traders so that they can track the index or track the stocks in an easy manner by the online. In the late 90s and early 20s, the volume traded in the NSE overtakes the volume traded in the BSE. Therefore, the NSE also created the benchmark called Nifty 50, which tracks the top 50 companies traded in the Indian stock market with the highest market capitalization. Then it's changed into highest floating market capitalization with the liquidity of trading. Okay, now let us interpret what Benjamin Graham says in his book with our Indian stock market. The first point Graham says is, don't expect a bull market to be always there. India also faces a serious decline over the decades. The first one is 1992, the Harshat Mehta scam, followed by the Hathan Parekh scam, and in 2008, the financial crisis led by the US, which is impacted the stock market all over the world, and India also faces a serious decline in that. And in 2019-20, the COVID, which also made the clear fall in the stock market. And in recent days, the Russia-Ukraine war also made us the market so volatile. And investors should always be ready to face the market serious decline without a panic. That was the first point Graham mentioned in his book. Okay, the second point Graham says is, the market will always get back to its mean. It means that the mean stated here is the P by E ratio of the index. The average P by E ratio of the index is 20 to 25. Whenever the P by E ratio is ahead of 25, let us consider 30, then it will always reverse and get back to its mean, or vice versa. Whenever the mean is below 20, let us consider 15, 16, then the market will always tend to get back to its average mean. Graham also advises us to buy a stock whenever the company doing a very good business with the steady growth in earnings, and if the price to earnings is relatively very low, then it's a very value investing. We should always consider buying the stock and hold it for a long period to get the adequate return from it. Okay, the third point Graham says is, by looking at the index, one should not consider the stock market is good, because the index is always represent the high market capitalization companies. By seeing that, no one should consider that the stock market overall is looking good or looking bad. Okay, the fourth point Graham says is, if we enter the market at the wrong time, then market will definitely punish us. Let me show in the screen. Okay, right now we are seeing is the monthly chart of the Nifty 50 index. Okay, now let us go back to 1992. Okay, this is the 1992 where the Hartas Mehta scam got at 1992. At 1992, the market is at 12,082. Let us see here. Okay, if we see in 1982, March 2, the market is at 12,061. If we invest here, then till 1999, we don't get any return from the stock market. It is almost 8 years. For 8 years, we don't get any return in the stock market. That is, Graham says, if we enter the stock market in wrong time, then we could not get a return from the stock market. And let us see the second scenario. Okay, the second scenario set by Graham is the 2008 and to 2014. In 2008, we all know the Great Depression. Okay, now let us consider one who buys at the wrong time, that is at 2007 or 2008 beginning. At that time, the index is trading at 6,357. Okay, till 2014 February month, the index is at same level. It doesn't go anywhere. Same at 6,300. If we put 1 lakh here at 2008, then after 6 years, it will be 1 lakh in the stock market itself. I'm saying without considering the inflation in it. Okay. Graham says that market will always punish one who is optimistic in future and enter in wrong time. Okay. Now we are in the August month of 2023 and we don't know where the future of stock market will go. Okay. Now we are here and it is 2025 and it is 2030. No one knows whether the market will go high from here or go down from here. The Graham says is always we should consider having a high grade bonds in our stock portfolio and a common stock portfolio so that even though the market doesn't give any returns over the period of time, we can get an adequate return from our high grade bonds. Okay, let me conclude this video by saying that future is always uncertain. Nobody can tell where the stock market will go from here after 10 years or 20 years. It is always pegged with the earnings growth of the company and the economic situation. And Graham also states that no one should expect anything from the stock market so that even though the smaller returns we are getting, we could enjoy it. And the fun fact I am saying you is it's been 25 years since the Nifty 50 index was formed. And you know what? 15 stocks is the major stocks. From then to till now, it doesn't get out from the index. This is the general portfolio policy of the defensive investor. We are going to see in the chapter 4 the defensive investor and the portfolio policy. Stay tuned. Thank you.